All right. Welcome, everybody, to this week's deep dive. We are going to be talking about debits and credits, which obviously is not specific to QuickBooks Enterprise, but QuickBooks Enterprise does have some more elaborate debits and credits because it has some more elaborate workflows that you can do. But we had a request from the audience that we wanted to go back to some basics, so that's what I'm going to hit on today. It's kind of like an accounting overview, but one of the things I like to say when I'm doing any kind of consultation with a new client is I like to ask them, do you want me to do debits and credits talk, or would you prefer that I keep it higher level than that? Because sometimes that's just what makes people's brains click, is understanding what is happening behind the scenes. So let me go ahead and head through this. Of course, we do have our YouTube channel, so if you miss any of our videos, we have a whole playlist out there for all of these enterprise deep dives. There's actually several playlists out there for different courses that we have had available over the years. We also have a Facebook group, so for the QuickBooks Enterprise specific user group, if you have any questions you want to ask to your peers, that is a great place to do so. We do have on-demand support, so if you never want to have to call Intuit support again, as I say every week, you do not call Microsoft, you call your IT person. Well, we are your IT person for QuickBooks. So if you want to take advantage of this, definitely reach out to me and let me know. All right, debits and credits. What are debits and credits? So in the accounting space, right, debits and credits are basically the two sides of a transaction moving amounts, right, from one account to another, right? In the most ideal state and in the QuickBooks state, when we have a transaction, when we have an amount, we have $100 received into our bank account, there has to be an offset to that. You can't just say, I received $100. You have to say why. So it can't just be cash goes up. There has to be an offset to it. Okay, so that's one of the principles in accounting. In some accounting systems, they will have no offset. They will allow for no offset. And so that's where sometimes, and that's sometimes when you look in some of your previous accounting systems, if you guys had exposure to it, you'll see, right, like I have an AR subledger, which is an actual separate ledger from my general ledger. You'll have an AP subledger. And in those subledgers, you can have postings to like lower the subledger account, lower the accounts payable account, and you have nothing to offset it. Now the expectation is the offset is hitting maybe a different module somewhere, a different ledger somewhere, right? The offset doesn't have to do with AP, it has to do with somewhere else. That is the expectation. It doesn't always happen that way. A lot of times when we get when we're doing conversions for people, we will have these transactions that are hanging transactions, and we basically have to go to the company and say, what do you want to do with this? In QuickBooks, though, QuickBooks requires an offset. It always require an offset. If you don't have an offset, it will shove it into a place for you, right? So you'll see something like uncategorized income or uncategorized expenses. If I receive cash in and I'm saying, I don't know what the other side of it is, it's going to just throw it to uncategorized income. Okay, so it has to throw it somewhere, which is actually good that it has to throw it somewhere, because it's better to have it somewhere, right? Like I expected it to be income than ghosted, or I have no idea what, I have no idea. So when it comes to debits and credits, T accounts, you'll hear that a lot when people set up a T account, which is basically they set up literally a T, right? And then they'll put debit on the right side column and credit on, debit on the left side column and credit on the right side column. And they will figure out, right, I have $500 on debit, so therefore somewhere I have to have $500 on credit, even if it's $500. $100 transactions. Quantity 5 times $100 transactions. There has to be an offset. We'll look at this inside of QuickBooks. The things that I want you to understand, though, is this concept of natural debit balance and natural credit balance. This is one of the things that it took me quite a bit of time when I was in accounting to understand and grasp. This is just a memorization thing. You just have to remember this, right? It's kind of like when you're doing sight words, or when you're learning how to read. These are just things that you have to remember. So when we say natural debit balance, what that means is that on a financial report, to get a positive number to show up on the financial report, meaning a balance sheet or a P&L, you have to use a debit. So let me hop into QuickBooks and show you what that means. When I come into, well, I have all these things open. When I come into QuickBooks and I run my balance sheet account as an example, in order to get a positive number here on the balance sheet in the asset section, it is a debit. Okay. We're going to be using journal entries a lot today, and then transaction journals, because that shows us debits and credits. So if I go in and make a journal entry, and I want to affect the cash account in a positive way, I want the cash account to go up, right? Positive. We're saying natural, it's positive. You want that to go up, I need to debit. So right now I have in the checking account $18,000. If I add an additional $15,000, debit, it's a natural debit to make it go up, to make it be positive. Okay, I'm just going to throw it to something for right now, just so you guys can see it. When I hop on back to my balance sheet now, it says $33,000 because it went up. Right? If I wanted it to go down, then I would flip it over to the other side to a credit. So if I put in $15,000 here, $15,000 here, right now it's going to take that original $18,000 that we saw and subtract out $15,000. Okay. So when I say natural debit balance, what we're saying is this is what makes it positive. This is what makes it go up. If we put it in the debit column, it will make it go up. So assets, debit goes up. COGS, cost of goods sold, cost of services sold, goes up. Expenses, debit makes it go up. So again, when I went back in here on my journal entry and I had professional fees, debit, because this is an expense account, for $15,000, this is actually making that account go up on my P&L. So if I could look at my P&L. And I look at professional fees. Okay, right now I have $15,000, and it's a positive amount. That's all I had in there. I didn't even have anything else, so that's perfect. You guys can see that that $15,000 amount is all that's sitting there. If I flipped it, like we had done before, and put it as a credit amount, okay, and I look at the P&L, now it's going to show a negative because it's taking away. Okay, so if I want to have a natural or a positive effect on assets, cost of goods sold, or expenses, it's a debit. Now let's look at credit. If I want to have a natural effect on liabilities, equity, or income, it's a natural credit balance. Now, it seems super weird because you're like, okay, well, in this one, I'm adding to, when I put it on the left side, it makes it more positive. Now, in this case, what I was saying is when you put it on the right side, it makes these accounts more positive. Okay, so let's take a look at balance sheet first. If we come down here, I'm not going to do to accounts payable because accounts payable is always a little bit, right, like you have to put in a vendor name and all this stuff when you're doing a journal entry, but let's just do it to my credit card. Not that we'd ever recommend hardly doing a journal entry to a credit card, but we're going to do it to a credit card. So I come in here down to my credit card. Whoop, just accounts payable anyway. Come on down here. Now, when we say natural is credit, that means to make it go up, it has to be on this side. Okay, so I put it on my credit card liability account. On my balance sheet currently before I save, it says $657. As soon as I save this, it makes it further positive $15,000. Okay, so it brings me up, makes it go up. All right. Same with if I do, let's look at income. So revenue repair service is $216, positive $216. If I move this journal entry against revenue service entry on a credit and I say save, it moves it up $15,000. Okay. So when we say natural debit and we say natural credit, that means this is what will make it move up if you do this on a credit side. If I go in on a liability account and I put a debit, it will make it go down, right? It'll subtract away from that number or possibly make it go negative. Hopefully that makes sense. If you guys have any questions, throw questions at me. Okay, so now what we're going to talk about is we're going to talk about inside of QuickBooks, what are these different transaction types and what are the debits and credits behind them, okay? So if I go to my home screen here, we will start out up top, and I'm going to go at a high level. We will start out up top. Up top here, we have purchase orders. Purchase orders in the system are non-posting. So they actually do not post to your GL. However, if you go into reports and transaction journal, you will see a GL posting in here, okay? So what it does is it's kind of a holding place. It doesn't post to the actual general ledger, but it is a holding place for us to be able to figure out what the debits and credits will be. Okay, so it picks up the materials inventory, right? It will affect materials inventory. It will debit materials inventory. Materials inventory is an asset account. So it will debit it, meaning it will go up. Okay? And then it credits an account called purchase orders, which is actually an account that QuickBooks creates. It's at the very bottom of your chart of accounts list. Purchase orders, estimates, and sales orders, if you use them, will show up as non-posting. It's basically just so that it has this offset that is not affecting your books. Okay, so purchase orders, we actually don't need to worry about. You can see the transaction journal. You can see the debits and credits of it, but it's not a real posting. It's not actually posting into the general ledger, which again means it will not post to your financials. When I create a purchase order, it does not affect my P&L. Not affect my balance sheet. Moving along, if we enter in bills or item receipts, they have a similar effect unless you have enhanced inventory turned on, which we have a whole other video on that. But when I enter a bill, when I think about this, right, I'm entering a bill into the system. I'm going to make it a nice $1,000 because it's just easier. In the bill, my accounts payable is going up. Right? When I enter a bill in the system and saying, I owe someone more money for accounts payable, my accounts payable is going up. So if we think back to our, what is the natural debit or credit, right? Where do liabilities fall? Give you a second to think about it. Liabilities fall under natural credit. So in accounts payable, for accounts payable to go up, it needs to be a credit balance because that's saying I owe someone more money. It goes up. So I enter a bill for $1,000. Accounts payable is going to go up, credited for $1,000. On the other side of it then, because we know you have to have a debit and a credit, right? And there has to be, so now I know, put it in here just so you can see. Now I know accounts payable is going to be credited for $1,000. It's going to go up. Now I have to think about what is my offset? Where should that go? Okay, so inside of QuickBooks, this is one of the things that what we do very well here at Fourlane is we figure out how to use transactions to get to that end result that we're looking for. So in most cases, people enter a bill and it goes against some kind of expense account, right? And expenses need to go up. So what is the natural state for expenses? Debit. Oh, look at that. We have $1,000 liability. We have $1,000 expenses. Perfect. They balance. Makes sense. Ding, ding, ding. Right? So the offset down here can be some kind of expense for $1,000. So we see this in a journal entry. Never suggest actually doing these things in journal entries. Journal entries should only be used if you cannot figure out a transaction till you do it, which should be very rare, right? Because you can't, there's a lot of things you can't do on journal entries, like you can't have extra custom fields, you can't have items. I mean, that alone. Okay. So up here, my top part of my bill tells me what's going to affect accounts payable, $1,000. My bottom part of my bill tells me which account will be. It doesn't even tell me that it's going to affect expenses, although you can see this is an expense account. But it tells me that somewhere else I'm going to debit. I'm going to credit $1,000 to accounts payable. Somewhere else I'm going to debit. Now, there are cases, right, where maybe we don't debit an expense. Maybe we are debiting something that, like we are debiting credit card, because I have a bill I'm putting in my bill for my credit card. Okay, both of these are liabilities. One is going up, bill accounts payable is going up, and at the same time, my other liability is going down, because I'm saying I'm paying off my credit card by entering this bill in the system, or I'm moving the balance out of my credit card into my accounts payable. Okay, so it can, even though it is a liability also, which has a natural credit balance, in this case, I'm trying to lower the liability by putting the bill in. Right? Some other examples that you might see is maybe you have to put in a bill because you're refunding someone money. So income has a natural credit balance, right? Natural credit balance, just like liability. So if I want income to go up, then I have to make sure that it is being credited. Now in this case, I need my accounts payable to go up because I owe somebody money. So that's why I put the bill in for accounts payable, $1,000. If I, on this side, choose an income account, then it's going to make the income account go down. It's going to subtract away from the income because it is going to debit the income, right? And because income has a natural credit balance, debiting it will make it go down. Now, why would I do this? Maybe I have to issue a customer refund. Right? That could be a reason why. Usually you don't do that as a bill. You usually do that as just a straight check. But I just want, hopefully it's coming together a little bit. On any transaction inside of QuickBooks, once you save it, because one thing that QuickBooks does, I mean, on the expenses tab, it's pretty straightforward, right? I know up top is hitting my accounts payable, down below is hitting my pool cover and equipment sales. The up top portion is always going to be one singular line because it's just going to hit accounts payable. The down below portion can be multiple lines. So I can hit equipment sales for 500, and I can hit whatever gas expense for 500. Okay. Both of these are still going to be debits because this is still a credit. So if I do $500 to income, it's going to lower income by $500. And then if I do $500 to expense, natural debit balance, it will raise expense by $500. Okay. So I can split those out and you'd see the same effect. Now expenses is pretty straightforward, as I was saying, but you can also use items. Items, I don't know where this item's pointing to. So if I put the item on here for $145 for one, I can't easily see on this transaction which account this item is going to affect. In a lot of other softwares, not all of them, but in a lot of them, in a lot of other softwares, they will have the item and the GL account code that it affects showing on the screen. In QuickBooks, it doesn't do that. You can get it to report, which I'll show you in a second, because QuickBooks is trying to be more simple, right? It's trying to, the less data that you put in front of people, the less they have to think about it and worry about it and all the things. And the item was set up appropriately, so why do we need the GL account code? Why do we need to put it there? But if you have an item on here, let me recalculate. So it picks it up. Now it's $1,145.50. That is still the credit. So this is going to be a debit. No matter which account in the chart of accounts it points to, it will be a debit. Okay. So let me save this transaction. And again, we can come over here to Transaction Journal. You can go up to Reports, go down to Transaction Journal. Okay. In here, if I do Transaction Journal, I'm going to see behind the scenes what's happening from this bill. So credit, $145, $1,145. That's what we expected. Accounts payable is going up. Perfect. We are debiting $500 to a pool, cover, and equipment sales, which is an income account, which would make it go down. Also debiting $500 to gas expense, which would actually make it go up. And then debiting materials inventory, which is where this item points, is materials inventory. It's going to be a debit there. Materials inventory just happens to be an asset. So it's going to go up. Okay. So some of the things that we can do is we can, knowing where one side lies, like this bill is going to hit accounts payable, nothing I can do about it. The top portion of a bill is going to hit accounts payable. Then, based off of knowing that is a fact and there's nothing I can do about it, I know I can control what is happening in the offset. So I know what is happening in the offset in the debit, and I can figure out where I need these things to go. Okay. So you find the fixed thing and then figure out the bottom part. Now we do a lot of things here where we'll get creative. We'll do what we call $0 bills, right? So we run it through as a bill so that we can use items, but we make it a $0. So it's a zero effect in accounts payable, the top part, right? Zero effect in accounts payable. But down below here, I'm going to do a whole bunch of things, and then maybe at the end, I don't know, have some account that I'm doing the offset to. So the negative 1145.75. For whatever reason, I did it to Greece, right? And then, so the two, well, something I was off here. 25. Nope. Anyway, I don't know. I'm off slightly. So in the two together here, right? 50? 50? There we go. The plus 1,000 over here, the total of negative 1,000 over here nets out the amount due to 0. But I'm just sending these amounts into these different buckets. And I know that all of them will be debits. Okay? This one will be a negative debit, which is a credit. So the credit, instead of hitting the liability up here, hitting the accounts payable up here, will instead hit whatever account this grease is going to. Because a negative debit is a credit. So if I go back to my journal entry as an example too, if I try to put in a negative 1,000, look what QuickBooks does when I tab across. It just pops it on over to the credit. Try to put in a negative 2,000, whoop, pops it on over for me. Because negative debit is a credit. A negative credit is a debit. Okay. Okay, we just have a couple more minutes. So, and if you guys have questions, again, if I can't get to them during this, I will get to them after the fact. So this is a lot of conceptual things, and I want to just get through. So we did bill. If we do a check, oh, I'm sorry, just real quick before I hop off a bill. Bill credit, right? If you think about bill credit is the opposite. When I do a bill credit, I'm saying I want it to come out of accounts payable. So if I want it to come out of accounts payable, I need to debit accounts payable. So when we flip this over to credit, the top portion up here, right? Let me get rid of these items. The top portion up here is actually going to debit accounts payable, which will make it go down. And if it's debiting accounts payable up top using this, this area up here, the down below here is going to then credit whatever accounts we chose down here. Okay, so bill versus credit. Bill is natural, credit balance. A credit, which is confusing, right? But this is really a bill credit. That's why you hear people on our team say bill credit. A bill credit is not the natural state, right? That's not how we wouldn't just only run a whole bunch of bill credits through accounts payable, because that would be weird. We should have a whole bunch of bills running through accounts payable. The bill credit is kind of the few and far between, most likely. The bill credit is going to take away from accounts payable. So it's going to debit. All right, checks. So let's do checks real quick. Baking right checks. If I take a look at a check, okay, this is a liability check for payroll items. Let me do something that's not payroll. Payroll is just a lot. Okay, here we go. So here's some for maintenance. So check, we are lowering our bank account when we write a check. If we want our bank account to go up, which is an asset, we would debit it. We are lowering it. So this top piece is going to be a credit to our check account. Then down below, since I know this is going to be a credit, what's going to be down here? Debit. Debit, debit, debit. So it's going to debit whatever I chose down here, which happens to be an expense. And when I debit an expense, it's going to go up. Okay. So on this transaction, if I look at the transaction, not transaction history, sorry, transaction journal, what do I see behind the scenes? I see a credit to checking, and I see a debit to maintenance and janitorial expense. Okay. But the biggest thing to note is that on a check, the top portion is going to be a credit to there. Now, on a credit card transaction, if you think about credit card transaction, this is a liability, right? A credit card is a liability. When I buy something on a credit card, I still owe someone some money. I may not owe the vendor that I paid, but I do owe the credit card company. So when I buy something on the credit card, it's a liability. If I want it to go up, I need to credit it. So in this case, I'm charging on the credit card for $1,000. So I know that that will be a credit, and anything else I do down below here will be a debit if it has a positive balance. Okay. flip on over to invoices. When we create invoices, a couple things to note on invoices. Invoices, you cannot have, there's no expense tab or income tab to invoices. You can only use items. So you have to have your items on point here. And this is where a lot of times people use those transaction journals. Where does this item go to? What is happening with this transaction? We hear that a lot. What is going on with this transaction? So on here, if I think about it, right, my invoice, my total invoice, which is reflected down below here as opposed to a bill which is showing up top. My total invoice is for $250. Right? So someone owes me $250. That means my accounts receivable balance, which is an asset, is going to go up by $250. That's my debit. So anything else in here is going to be a credit if it's a positive amount. Okay, so it's going to be a credit. Now, most of the time when we invoice someone, we're selling them something, right? And so when we say it's going to be a credit, positive amount, a credit raises our income. Does that make sense? It all comes together. So on this one, if I go into reports and transaction journal, behind the scenes, you can see what is happening. Now this is an extra one because webinar part is actually an inventory part. So let me actually throw an inventory part and let me throw a service item on here and see save. Okay. Reports, transaction journal. Okay. So I have my total accounts receivable, $589,295. When I go look at my invoice, that's that total balance due down here. $589, that's a debit. It's making it go up. Accounts receivable is going up. Somebody is going to pay me $589.95. I'm going to skip down here to the item of installation. So this is a service item. When we set up service items in our chart of accounts, oh, there it is. We set up service items. We can have them go against one account for income or one account period, right? Or we can split it and have when it's on a sales transaction, it hits this account. When it's on an expense type transaction, it hits this account. When it's on an invoice or a sales receipt, it hits over here. When it's on a bill, a check, a credit card transaction, it hits over here, right? So in this case, we only had it hitting income. That was the only, which we don't recommend that setup, but you know, this is a sample file. So you see that installation item, and it's crediting that account, which is crediting revenue, which means revenue is going up. Okay. So from that one item, $335, $339, it's $339.95 of this $589 is being offset to income revenue. Now, inventory, we have a whole video on this. So we have an inventory video on inventory debits and credits. So go check that out. It's a lot complicated. But in this situation, let me just run through it real quick, right? Because when you have inventory on a sales transaction, you're affecting sales, but you're also lowering inventory and raising cost of goods sold. So in this case, I have my $250 in sales revenue right here. That is making my revenue credit, just like the credit down here. So my revenue is going up. My inventory, which is the value of this inventory, which is valued at $200, is going down because this is an asset, right? And I want to lower it, so it's being credited. And then my cost of goods sold, which is similar to an expense, natural debit balance is going up. So I want to debit it, okay? But we have a whole other video on inventory stuff. All right, I'm running out of time, guys. I'm 5 minutes over. If you have any questions, please definitely stick them in the chat there. I have a couple of things coming up: chart of accounts organization, account types, chart of accounts, account terminology. I had all these questions coming from the audience. This is what we wanted to see. I do need to know what else you'd like to learn. We're here to help you guys. Email me, put it in chat. I'll leave this open for a little bit. Tell us what you would like to learn. All right, that's all I got for you today. I hope you guys were able to take away little bits and pieces. Have a great rest of your week.